us this afternoon. My name is Jared Marshall. For those of you that may not know me, along with my partner, Damon Slepian, who's also on the call, we are the financial advisors for the Phoenix Contact 401k plan. And we are here today to discuss making the most of your retirement assets. I know there's some important decisions to be made over the next couple of weeks, months, or years. So we want to make sure that you have the options available to you. You have the knowledge in order to make these key important decisions with one of your most important benefits. So it's not our job here today to tell you what to do or what direction to go in, because everybody's situation is going to be different. Instead, what we're going to do is set the table and let you know the pros and cons of each of your different options so that you can ultimately make your own decision. What I will say is it can be very complicated, and there's a lot of moving parts involved in decisions with your 401k plan or your other retirement assets. So if you are interested, Damon and myself, we are resources for you. We're happy to offer one-on-one consultations, which we'll bring up multiple times throughout this presentation. But if you want to have a one-on-one conversation and see what might be the best fit for you, we're happy to do so. With that in mind, here's some important disclosures that we always like to include. I think the key thing to point out here is that any references to investment products, insurance, or annuity products that we have today, they're not FDIC insured, they're not bank guaranteed, and they may lose value. So what are we talking about today? And it's really whenever you have to make a decision with your retirement assets. If you were to make a move and there's a couple different paths that you can go, there's a lot of questions that may come to your mind. First and foremost, in most cases, is what are my tax considerations? 401k is just the line in the tax code that gives us these tax preferenced accounts that we would get relative to our checking, savings, or brokerage accounts. So at the end of the day, we want to make sure that you are saving the most on taxes over the span of not only your working life, but ultimately your retirement life as well. We're going to walk you through each of the choices that you do have for your assets as you're making some of these important decisions, and then some of the details, right? Can I make new contributions? How do I make new contributions? What are some of my investment choices? And what are some of the tools or resources that are available to me as we go through this process? So here it is. Let's set that table. So I'm going to walk you through each of the 5 different directions that you could go with your 401k assets, your retirement dollars, and again, the pros and cons of each. So to summarize, you can withdraw the funds, you can leave them where they are, you can move it to another provider, you can roll it over to an IRA or a new 401k, or you can convert it via a Roth contribution. The first one is withdraw the assets. On the surface, it is the simplest option. Just getting a check, you get access to the funds. However, generally speaking, this is the one that I reserve for a must, right? If you have to take the funds, if you need access to it, because the benefit is you get immediate access to the dollars. You can, by getting a direct lump sum distribution, you can go out and spend the money, deposit it in your checking account, and then you have complete control from that point forward. So if you want to spend it, if you want to reinvest the dollars, you have that flexibility. The reason I say that it's kind of that last-ditch effort or that last option for most people is the tax impact. When you take a taxable distribution from your 401k plan, in our case at Merrill Lynch, we have a mandatory 20% tax withholding and then a 10% penalty if you are under the age of 59 and a half. So that can be a pretty big bite from the apple. So generally speaking, that's reserved for people that absolutely need the funds, not people that are looking to keep this in for a longer-term retirement plan. Another consideration that you have when you are taking a lump sum distribution is you can't put those plans back in, right? You can't put those assets back into your former employer's plan. Once it leaves the Phoenix Contact plan, it's gone, right? So you have to either then take it and put it into an IRA, put it in your checking savings account, or roll it into a new employer's plan. There's also less potential for that tax-deferred future growth. If you were to take that taxable distribution, on the surface, there's that first tax hit that you have from the taxes that are due in that year, and again, potential penalties, but also the long-term potential for that tax-deferred growth. If you were to put this money into your checking, savings, or brokerage account, moving forward, any earnings, any interest, any dividends that you get in this account, there's the potential for a tax bill there as well. So in your current 401k plan, you get the benefits of the tax-deferred growth. As long as the money stays in there, there's no tax on interest, there's no tax on dividends, there's no tax on capital gains, but in a checking, savings, or brokerage account, you may be exposed to those taxes.
Jared?
Yes.
We have a question. Does the plan allow a rollover or a loan for current active employees, or is the only way to roll over is to retire?
If you are an active employee, as long as you are 59 and a half years old, then you can take an in-service distribution. So you're able to withdraw the funds. There is no loan provision with the Phoenix Contact Plan.
We do have hardship withdrawal, which maybe you're going to talk about that a little bit. So I don't know if you want to touch base on that now.
There are hardship withdrawals. So if you are under the age of 59 and a half, you are able to get access to these funds, but they have to follow strict IRS guidelines. There's 6 qualifying distributions that you can take, and generally speaking, it's musts, not wants, right? It's usually reserved for unreimbursed medical expenses, funeral expenses, repairs to your home. If you're looking to purchase your first home, for example, then you would qualify for one of these hardship distributions. But if you just need money to cover a short-term bill, or if you're looking to, I don't know, buy jet ski, right? It's usually not reserved for that. You have to justify it and provide documentation in order to get one of these hardship distributions.
Thank you.
Of course. The second option that you have is do nothing, right? You can leave it in your former employer's plan. So you don't have to make a decision. There's no ticking clock for you so long as your account balance is over $7,000. Technically speaking, if it is less than that amount, and you are no longer employed with Phoenix Contact, they can do some cleanup, right? They can go in and some of those smaller balances, they will make a decision on your behalf. However, it's above that limit, you can leave it as it is. And you're effectively living your life as if you were still employed with Phoenix Contact. You just can't make future contributions to the account. So you are, from a pro perspective, getting access to familiar investment choices. Nothing is going to change there. Lower cost than you might feel in another type of account, checking, savings, brokerage, IRA, or new 401k plan. You might get some lower costs available there. And then you still get that benefit of the tax-deferred growth, right, compared to taking a taxable distribution from the account. There are some options. I'm going to walk you through some of the key years that you have. I already mentioned 59 and a half. 55 can technically apply in some cases for taking some of these early withdrawals and avoiding that 10% penalty. Another kind of overlooked view from a 401k perspective is if you were to leave the money here, is there's some added protection that you get from creditor claims under federal law by keeping the money in a 401k plan versus, let's say, an IRA. Some of the main downsides to leaving it in the plan is maybe you want to buy something specific. You want to have a specific investment. Well, as much as we love the Phoenix Contact menu, it is an investment menu that you have to follow. So if you do want to go outside and buy something specific or have some sort of specific investment strategy, you would have to move to a different option, namely a new 401k or IRA, in order to do so. There's also some of the plan rules that you have on distributions. So if you were to leave Phoenix Contact and leave your money in the 401k plan, there is a rule in this plan that if you do take a bit out, you do have to take it all out, whether that is one of the other 4 options. But you can't just take a piece out of the 401k plan and leave the rest if you are no longer employed with the company. I mentioned it earlier, but you can't make new contributions. So if you are looking to get the benefit of increased savings, increased tax-deferred growth, you would either have to do so in an IRA or if you have a new employer in your new 401k plan. The last thing to be mindful of, this is for those of you that are 73 or approaching 73 and beyond, is required minimum distributions. You want to be mindful that at a point in time, right, in most cases age 73, when you are no longer employed, the government is going to force you to start taking money out of your retirement assets. If you are over 73 and still employed, you don't have to do that, right? You don't have to take those RMDs. You don't have to take those required minimum distributions. So if you're 73 or beyond, this could be something that you want to consider. And if you're below that age, it's something that you want to have in the back of your mind if you were to leave the assets in the plan. Option 3, moving to your new employer's plan. So if you're choosing to leave Phoenix Contact and move to a new employer, you can always roll over to that new plan, right? The nice benefit of that is you're getting access to potentially new investments. Maybe they have a menu that better suits you based on your specific wants and needs. And primarily, you're going to be avoiding that immediate tax, right? And avoiding that early withdrawal tax that you have. By moving from one plan to another via typically a direct rollover, it's not a taxable event to you. Right? There are some tax filings that you're going to have to take place, but you're not actually going to have any sort of withholding. There's going to be no penalties involved. And the main benefit of that is, again, preserving that tax-deferred growth. Moving from one plan, you're going to another. The tax treatment will likely be identical. Another nice part of that is, again, for those of you that may be 73 or beyond, those required minimum distributions are not required if you are still working. As long as you still own more than 5% of that company, you don't have to take a required minimum distribution from your current employer's 401k plan. So to simplify that, if you were to leave the money in the Phoenix plan and you're 73 or beyond, you need to take an RMD. If you were to roll into your new employer where you're actively employed, actively contributing, you no longer have that required minimum distribution until you leave that company. Loans. So the Phoenix plan does not have loans, but a lot of 401k plans do. And if you do need access to quick cash, right, maybe you're in a transition period and you need to get something to cover you as you make this move, you might be able to access a loan via your new employer's retirement plan. And again, 401k here, 401k there, you still get that broad protection from creditor claims under that federal law. Some of the downsides of it, yes.
I'm sorry, we have a question.
Okay.
I didn't mean to interrupt. Can you roll over to an IRA and not close your 401k to invest in, for instance, a CD?
If you are no longer employed with the company, the take a little, take it all rule still applies. So if you are still employed with the company and you qualify under the normal retirement age of distribution, you're 59.5 and beyond, still employed, you can take a portion out, move it over to an IRA and buy that specific investment. But if you are no longer employed, you're considered terminated with Phoenix Contact, then if you take a bit, you have to take it all.
Thank you.
Of course. Some of the disadvantages of moving to the new employer plan is just their rules, right? Some plans don't allow rollover. Some of them won't accept it. Most do, but every so often I come across one that doesn't. But more importantly, in a lot of cases, is that there's a waiting period in order to enroll. Some plans can require you to be a certain age. Some plans require you to work for a certain period of time, namely up to 1 year before you're eligible to start contributing to that plan. So you need to make that consideration before you make a decision. And if you are looking to a new employer, you'll want to understand what the rules and features are of that plan. And again, investment choices may be limited. Maybe you like the menu that is over here at Phoenix Contact and you don't like the new menu. Well, that could be a deciding factor for you as well. Option 4, rolling over to a traditional IRA. Again, not a recommendation, but I will say when people leave the company, this is the most common option that I see people pick up. And it is because it presents the most flexibility. So again, the name of the game is taxes. You do get the benefit of that future tax deferred growth by moving from a 401k plan over to a traditional IRA. The tax treatment is effectively the same, even though there's some small rules and features that differ. You can then also continue to make contributions to a traditional IRA, right? If you're no longer employed with Phoenix Contact, you still have some active income, you can make contributions to an IRA. But generally speaking, if I'm in your shoes and I'm making that decision, I want to open up a new traditional IRA just to keep the tax management a little bit simpler. The nice benefit of these IRAs is you can invest in almost anything under the sun, right? As long as it's eligible to be in an IRA and your new broker, your new where you keep the assets allows it, you're going to be able to invest in really more and more of these investment choices and take advantage of these planning tools. And from a investment knowledge standpoint, if this isn't something that you're overly comfortable with an IRA, you're able to lean on investment advice. This is where you can go out, you can hire an investment advisor, you can hire a financial advisor to help you make these important investment decisions if it's something that you're not necessarily comfortable doing on your own. From a downside perspective, it takes away some of the strategies that you have as far as taking early distributions. I'll talk about the rule of 55 here in a moment, but it generally doesn't apply to Phoenix Contact plans. So I'm going to walk over that for just a second. Loans are not available from traditional IRAs. So if you're considering moving to a new employer versus rolling over to an IRA, the new employer plan might offer those loans. IRAs, you don't, right? Generally, you can get access to your IRA funds regardless of age. You may experience a penalty, but there's no loans. You can't then pay it back over a span of multiple years and get the tax advantages of a loan. They do get protection from some creditors, but it's only in the event of bankruptcy. So the 401k generally gets a higher level of protection than the IRA does, but it does still offer some level of protection. And then there's some additional potential fees, right? The costs could differ widely based on how you and where you choose to invest those funds. So depending on the products you choose to purchase or who you choose as a provider, or if you do lean on an investment advisor, those costs can vary widely. So you're going to want to keep an eye on that as well. Roth. So this is where it gets a little complicated. So for those of you with Roth dollars, generally if you're going to an IRA, you're going to want to keep those Roth 401k dollars and move them into a Roth IRA. But for those of you that are considering with your pre-tax or traditional dollars, you do have the option to convert those assets into a Roth IRA. What's the benefit of that? Generally speaking, the withdrawals from a Roth IRA are going to be tax-free. As long as you keep the account open for at least 5 years and you're 59 and a half years old, all of those withdrawals are entirely tax-free. There's some added benefits of a Roth IRA as well that you don't get with a traditional IRA or even a pre-tax 401k, namely that you can pass the earnings to your heirs, federally income tax-free. And the nice part about those Roths is whether you're working or not, you don't have those required minimum distributions. You're not exposed to RMDs. And the nice part about these Roth IRAs is the growth is tax-free. So if taxes do rise over the long run, we are, relatively speaking, relative to history, at a lower tax environment than we have been in prior decades. Well, it is a potential hedge against these rising taxes. Some of the disadvantages are, and the main disadvantage from doing a conversion is that you do have to pay those income taxes upon the conversion. So in that year that you make the conversion, you do have to pay those income taxes, and generally speaking, you have to pay those taxes with outside dollars. So if you have a large bucket of funds that you're converting over, keep in mind that you're going to want to have some cash outside of the 401k plan or IRA in order to cover those taxes. Just like with the traditional IRA, loans are not available in a Roth IRA. And then there's some limited opportunity for those early withdrawals. Again, if you're under 59 and a half, there's a penalty, and there's that 5-year window that you want to be very mindful of. Just like with the traditional IRA, some additional fees should be considered. So keep that in mind as you're making an important decision with where you move those funds, and you get a similar protection with that IRA, which is a little less than you get with a 401k. So Juan, I'm going to take a quick pause. Are there any more questions?
No, not at this time. Thank you.
All right. Perfect. I already alluded to each of these numbers, but just to kind of put a bow on it, is there's 3 main numbers that you want to be considering when you're making these decisions: 55, 59 and a half, and 73. I will skip over 55 pretty quickly, but I'll touch on it. Is that technically speaking, if you separate from service from your current employer and you're 55 through 59 and a half years old, you can technically take that money out without a penalty. So you can take a distribution. Usually don't see this with Phoenix contact plans because if you do take a bit, you have to take it all. So most people end up waiting until they're 59 and a half years old. But once you hit that second mark, that 59 and a half years old, that's when you can take this money out from your IRA or your 401k plan without that 10% penalty. Depending on the tax treatment that you have of the existing dollars, you still may experience some income tax from the distribution. However, you do avoid that 10% penalty. 73 is the other number that you want to be mindful of as well. Once you're 73 years old and no longer employed with this active 401k plan or even a traditional IRA, that's when you may experience these RMDs, required minimum distributions. When we're making these decisions, right, I just walked you through kind of the pros and cons of each, but I think it should all factor into not only your general retirement plan, but your overall financial plan. So we tend to focus on the retirement benefit here. But the retirement benefit, the 401k plan, is only one small component of your overall financial plan. So when you're making these decisions, you want to be mindful of, look, how is this going to impact your health coverage? How is it going to impact your paying for your home? Some of the other major goals that you may have as you're building out your broader financial plan. So that's why we have Damon here to kind of walk you through some of the planning tools and resources that are going to be able to help you make that decision. Damon?
Thank you, Jared. Yeah, I appreciate it. So I'm going to share with you several of the tools that are readily available to you. But before I get into that, I do think it's important just that we touch on Medicare. Health costs are significant consideration when planning for retirement. And because we really don't think about this unless maybe we experienced it with a loved one until it's time, let me just give you some key dates to think about with regards to Medicare. The primary concern that most people should be thinking is when do I enroll? When can I enroll in Medicare? And there's a 7-month window you should keep in mind. It's 3 months before your 61st birthday, the month of, and the 3 months after. And that's the primary period of time that you should be considering enrolling. So if you aren't yet receiving Social Security, because if you are, you would be automatically enrolled in A and B, this is the window that really should be triggering things for you. And even if you're involved in COBRA, if you were to separate service, you should still use the advantage of this 7-month window. There are other periods to consider for enrollment. That first one listed there is the special enrollment period, SEP. And it's basically reserved for people that are 65 and older and are still working and are covered by their employer plan, but maybe retire after that. And it's not in that window around their birthday. You do have up to 8 months post your retirement to enroll without any issues. There's another period called the general enrollment period, GEP, and you could sign up in any subsequent year after your 65th birthday, after that 7-month window between January and March, but you might have some costs associated with missing that original enrollment window. And then the final period that you really need to keep in mind, and this is an annual period called an annual election period, AEP. And each year you can make changes to your coverage between October 15th and the beginning of December. And that gives you the opportunity to kind of evaluate the coverage, any supplemental plans that you have, and to make any tweaks. There's a great video on a website I'm going to share with you in a minute that walks you through some of these healthcare considerations. It's 11 minutes. It's one of the longer videos on the site, but it is excellent if you've not really gone through this. Jaron and I also have a nice 3 or 4 page summary of all the pieces you might need to consider with regards to Medicare, from as simple as what is it, parts A, B, C, and D, what are they, and then all these dates that I'm talking about. So again, an important component as you're doing your planning as you approach retirement. Jared, if you don't mind. So one of the tools that we have that is available on your 401k website now is a service called Advice Access. And by and large, this is a free service available to everybody on the call. Some of you may have tinkered with it, but what is Advice Access? Advice Access is a tool that helps you make some decisions around how you're investing your current 401k plan. It'll actually cultivate specific recommendations for you depending the data you share with the system. It also gives you progress to your retirement goal. You'll see right on the screen, what we think based on how you're invested today, what your contributions are. It incorporates Social Security, and you may actually want to add in additional data, and it gives you an idea if your goal was X, how close are you to achieving that goal? And depending the level of service you decide to implement with this Advice Access tool, it will recommend changes to you over time as you age. So this is a great tool. Let's take a little closer look at it. Jared, if you don't mind. So like I said, it'll come up with a retirement goal, but you can actually put in a specific goal you want. It'll show you what your current projected income is and what you're trying to do if you maybe take the changes that they suggest. We find a lot of people may be too conservative potentially in their retirement assets, especially if they have long periods of time to take advantage of that time to compound returns. So we'll show you if you made changes, what are the proposed projected incomes with some changes that you might implement from the tool. Jared? The tool gives you 3 levels of service to use. One is, I'll start from the right and work my way to the left. You could go through the software, implement additional information. Remember, we know a bit about you. We know how old you are. We know what your balance is in the 401k. We know how the 401k is currently invested. We know where you're contributing your new contributions to. And from that data alone, we could estimate your Social Security payment. So we have a lot of data that gives this software kind of a running start. But you could actually tweak it and add additional information. And once you do, it'll produce a recommendation on, how much you should be deferring. If you were doing 5, maybe they say go to 7% of your salary. Or maybe if you were invested in XYZ funds, they may say, you should consider ABC funds. And again, once you're finished, you could walk away from it. Or two, you could do a one-time implementation where it basically just makes the investment changes, adjusts the rate, asset allocation, all those options for you, and then it's done. It'll never make another change for you. You could select portfolio rebalancing, and what this does is every 90 days, based on the recommendations it made and the investment strategy it implements, it will go back and rebalance. What does that mean in English? Let's say the stocks do fabulously well, and the original asset allocation was recommended at 65%, and because the markets perform so well, it's now at 70, making, say, the fixed income piece lower than the 35% it had originally recommended. It would sell the stocks and add to the bonds to keep the risk level appropriate. And it'll do that every 90 days. If you select personal manager, that will actually not only do that 90-day rebalancing, but as information changes about you over time, maybe you get a raise or maybe you increased your contribution separately from the recommendation, it will make ongoing recommendations and make those adjustments for you inside the 401k. So a very powerful tool, if for only the planning feature, let alone the investment recommendations. Jared? That's available on your Phoenix Contact benefits.com site, benefits.ml.com site. An additional resource you have is through Jared and I. We're happy to prepare what's called a personal wealth analysis, PWA, and it takes that advice access tool another few steps forward and incorporates a bit more information that you share, does some different projecting, allows for what we call what if planning. What if we save more? What do the outcomes look like? What if we change the asset allocation? What do the outcomes look like? It also can incorporate a spouse or significant other and see how the combined income and earnings would look. It allows you to plan for different goals, not just the retirement goal. Maybe there's a short-term goal to help a child with a first-time home purchase, and you wanted to see that modeled into your own plan. So this PWA is a very powerful tool. Again, that would be something in a private consultation, no cost to Phoenix employees. But as we say, garbage in, garbage out. The better the data we have to help do the projections and the analysis, the better the output and the recommendations. A little more on the PWA, just so you could see some of the visuals on it. Jared, the next page. It does basically a goal funding status. Where are we today with the assets you've accumulated? What does your balance sheet look like? What does your income statement look like? What do we project the growth to be versus the goals that you need? It also factors in all the taxes that we're estimating you would be incurring throughout retirement, which would change over time. Remember, if you're retired in your 60s, but not yet taking income from your 401k because you're fortunate enough not to need it, maybe other resources or Social Security satisfies your needs, down the road, you will be forced to take, as Jared mentioned, the RMD, the 73-year-old has to take a minimum distribution out, and that does change the tax picture. So this software allows to account for that and does allow us to do that. It also, like I said, allows us to model out different asset allocations, maybe one while you're still working, and maybe one a little bit more conservative as you get older. The next one is, if you don't mind, Jared, the education resources that you have available. One of the most powerful ones, and I briefly mentioned a video earlier on Medicare and health costs, can be found on the Events Center. That QR code is a live code if you want to click on it on your phone, or you can navigate to it on the website itself. And it's a collated list of variety of different weekly webinars, live webinars like this, produced by Merrill Lynch financial advisors on a variety of different topics, ranging from retirement planning to how to care for pets, believe it or not. There's a whole on-demand series of a variety of different seminars of a particular topic. Maybe you're still in that education planning phase for your children. And there's audio casts available, but a very powerful tool available to everybody and live, like I said, resources as well as recorded. Some other resources that you have in addition to the Event Center is a financial wellness tracker. For those of you who have not tried this, again, it's a similar format to the Advice Access I went over a minute ago, but it's a separate questionnaire. It's about 12 or 13 questions. The questions are dynamic, so my questions, because I'm 57 or soon to be, might be slightly different than yours if you're 65. But it does give you a variety of different questions. It does give you a score on how well you are financially, how ready you are for retirement, and gives you bite-sized things to do to get better and get more well, get more closer to a higher score for financial wellness. So again, nobody's tracking this. This is a private relationship you would have with the software, but it goes into a lot of things outside of how to manage your money. Things like, do you have an estate plan? Do you have powers of attorney? Things that you may not have maybe thought about as you approach, retirement, and different things that you need to think about, like Medicare we talked about a moment ago. And then the Education Online Center, which is where you can find the Event Center. I went briefly over that. You can find that either on that QR code or the education.ml.com is available to everybody. There is great information on there, and I wouldn't discount the Better Money Habits that are, again, bite-sized videos to help you kind of just get brushed up on certain topics. Jared? So just to kind of level set and recap what Jared and I went over, think about your choices. Think about the things that you could do now as you're preparing for retirement. Think about the options you have while you're working at Phoenix, or maybe as you transition in the future during retirement, for not only the 401k plan, but your choices about, enrolling in Medicare and the different choices there, your choices about how to manage your resources in retirement. And feel free to use Jared and I and ask questions to us. Schedule one-on-one consultations through the online services you have through the Merrill Lynch team at our Hopewell, New Jersey office. And again, we're more than happy to share with you the PWA, the Personal Wealth Advisor Analysis, if you need that as well. Finally, Jared went over the 5 different choices with a potentially former employer's retirement plan. We do have a piece that kind of summarizes everything in a bit more detail and all those pros and cons that Jared flashed up on the screen. And if you're interested in receiving that, feel free to email us and we could forward that out. And again, we don't have a screenshot of it, but I'm more than happy to include the Medicare, understanding your Medicare options piece, which again goes over some of the things that I chatted about a moment ago. So with that, Wanda, that is the gist of the program from us today. If there's any questions, we're happy to answer them.
Yeah, thank you both. I just have a couple comments I want to add to the presentation for today. So for everyone on the call who is listening to the video recording, the outside of the 401k, Jared and Damien are also financial planners. So everyone's financial needs are different. Retirement is different for everybody. So whether you're retiring next year, 5, 10, 20 years from now, you can work with them. It's a free service that they offer so that they can really connect with your financial aspect and where you're at now and what that's going to look like for you in the future. So we would encourage you to reach out to them and work with them directly on any questions that you have. We did have one other question. This is more of a benefit question. When is the last date or age one can contribute to an HSA, and can the employer still contribute to your HSA account after you stop contributing? So the most important thing I want to highlight here is, according to the IRS guidelines, if you want to be on a health savings account, you cannot have dual coverage, meaning that if you are 70 years old, for instance, and you are working full time, and you decide that you don't want to take the Medicare at that age because you have coverage with your job, that is fine. You can still have an HSA account. The employer can still contribute to that HSA account. But if you decide that, hey, I want to take Medicare, you now you are no longer eligible to have that HSA account. You cannot have dual coverage. So your contributions to an HSA would end, and what the employer would contribute would also end as well. You can still maintain an HSA account, you just are not able to contribute to it. So I just wanted to point that out. If you do have any benefit questions regarding any of the topics today, or any other benefit questions, don't hesitate to reach out to Jamie Cheatham or myself. We would be happy to. What about if a spouse goes on Medicare? It's the same thing. If you have a spouse that takes Medicare and they're on your coverage, they could still remain on your coverage, but how they get to utilize that HSA benefit piece would change. So there are some really interesting dynamics when it comes to Medicare and Social Security. I'll just drop this in here right now. I will include in the follow-up email, we have a Medicare and Social Security specialist that is available to all of our employees and your spouses and your or your family members. That is free, that you can reach out to them and you can specifically ask about Medicare, Social Security, and how to get yourself set up for success in those areas as well. So I'll make sure to have that contact information included along with Jared and Damien's contact with this recording. Are there additional fees for obtaining the Merrill PWA? It did look to me like the advice access comes with a cost. Jared or Damien, can you answer that?
So the short answer, go ahead, Damien.
Yeah, go ahead. No, you go ahead, John.
So the short answer is no, there is no added cost to it. And there's no cost for advice access. So advice access is totally free. There's no cost for that. And from a PWA perspective, that's something that we offer as being a participant in the Phoenix Contact 401k plan.
Great questions. Anyone else have any questions? And as you see on the screen, you see Jared's email, you see Damon's email. So again, feel free to email them directly if you have any personal questions that that you would like to ask but are not comfortable asking on this platform. We encourage, because the more that you know, the more you understand, and the more you can control, and you can set yourself up for success down the road. Because retirement is a truly wonderful avenue to get into once we all get there. So. Yeah, thanks for your time today, Jared and Damon.
Thank you.
Thank you.
Yeah, thanks everyone.
Appreciate the time. Thank you all.